Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
All right, so you want to understand how companies make those big money decisions,
Yeah.
where they get the fuel for growth acquisitions, all that. It's called capital structure.
Right.
And it's way more exciting than it might sound at first.
Yeah, it really is.
We're talking about the balance of debt versus equity financing.
The classic.
And believe me, those choices have real-world consequences for all of us.
Absolutely.
Yeah.
What's intriguing is how this balance can really make or break a company.
Right.
We're not just talking definitions here,
Yeah.
but how these decisions play out for companies you probably use every day.
Exactly. Think Apple, Tesla, Airbnb.
Right.
They're all wrestling with these choices constantly.
That's right, eh?
So our mission in this deep dive is to unpack not just what debt and equity are,
Right.
but how they shape the destinies of companies in ways you might not expect.
Yeah, for sure. Let's start with a classic example.
Okay.
Amazon's purchase of Whole Foods back in 2017
Sure.
for a cool $13.7 billion. They opted to finance that, mostly through debt.
Wait, debt?
Mhm.
Amazon's a giant.
Yeah.
Why not just use their own cash?
Smart question.
Yeah.
So interest rates were super low at the time,
Okay.
making debt cheap.
Right.
Plus, by using debt, Amazon avoided diluting its stock,
Yeah, okay.
keeping ownership more concentrated.
Interesting.
That's the kind of strategic thinking we're going to explore.
Okay, so debt can be a good place sometimes.
Yeah.
But it's obviously not the whole story.
Right.
Let's break down each side of this coin.
Okay.
What are the nuts and bolts of debt financing,
All right.
and when is it actually a good idea?
Debt at its core is borrowing money.
Okay.
It could be a bank loan,
Mhm.
corporate bonds,
Yeah.
you name it.
Okay.
The key is you have to pay it back with interest.
Right.
Now, this might sound simple,
Yeah.
but it's where things get interesting.
I'm already sensing there's more to it than meets the eye.
Yeah.
So what are the upsides of going the debt route?
I think the big one is cost. Debt is often cheaper than equity
Really?
because those interest payments are tax deductible.
Oh, right.
A nice little perk for companies.
Mhm.
Plus, you don't give up any ownership.
Interesting.
But of course, there's a
But
catch.
there's always a catch.
Always a catch.
Lay it on me. What are the risks?
Those mandatory repayments,
Okay.
they're the double-edged sword.
Okay.
They got to be made whether your business is booming
Right.
or barely scraping by.
Yeah.
If a company takes on too much debt,
Uh-oh.
a few bad quarters could spell disaster.
It makes sense. It affects your credit rating too, right?
Oh, for sure.
Like if you're constantly maxing out your credit cards,
Yeah,
lenders get nervous.
exactly.
Yeah.
Too much debt can lead to credit downgrades,
Oh, right.
making future borrowing more expensive.
Mm-hmm.
In extreme cases, it's the road to bankruptcy.
Yeah.
And remember, economic downturns amplify these risks.
Oh, of course.
Suddenly, that manageable debt
Yeah.
becomes a huge burden.
So debt is a bit of a gamble. High reward, but the potential for a nasty fall too.
Yeah, for sure.
What about equity then?
Right.
It sounds safer,
It does.
but I'm guessing it's not that simple either.
You're catching on quickly.
Well,
Equity financing is all about selling ownership stakes in your company,
okay.
usually through issuing stock.
Mm-hmm.
It's like bringing in partners,
Right.
each with a slice of the pie.
Okay, so less renting money like with debt and more like sharing the house.
Yeah, I like that.
What are the benefits there?
Flexibility is key.
Okay,
No mandatory repayments looming over your head,
right.
which can be a lifesaver for young companies
Yeah.
or those in volatile markets.
Mhm.
Airbnb's pandemic survival tactic comes to mind.
Oh, right.
They needed cash fast,
Yeah.
and issuing stock at that time would have been disastrous.
Why disastrous? What's the downside of equity?
Dilution, my friend.
Dilution.
Every time you issue new shares,
Yeah.
you're cutting that ownership pie into smaller slices.
Right.
Existing shareholders get a smaller piece,
Mm-hmm.
potentially impacting their investment.
So it's a trade-off.
It is.
Flexibility and cash now,
Right,
but at the cost of sharing future profits more widely.
exactly.
Are there any other drawbacks?
Equity financing also tends to be more expensive than debt.
Really?
Those investors buying your stock expect a return,
Okay.
either through dividends
Right.
or stock price appreciation.
Mm-hmm.
It's not just about the ownership stake.
Yeah.
It's the ongoing cost of keeping those investors happy,
Especially for public companies, right?
especially for public
Wall
companies.
Street's always watching, demanding growth and returns.
Always watching.
Yeah. So equity has its allure,
It does.
but it's not a free lunch either.
Not at all.
All right. So both debt and equity have their pros and cons,
Mhm.
their moments to shine, and their potential pitfalls.
Right.
This is reminding me of something you said earlier about Apple.
Oh, yeah. You're thinking about their massive cash reserves.
Yes,
Yet they still issue debt. It seems counterintuitive,
it does.
but there's a strategic reason behind it.
Yeah, it's like having $1 million in the bank,
Uh-huh.
still taking out a loan.
Yeah.
What's the logic there?
Tax strategy at its finest.
Okay.
Apple's cash is mostly held overseas.
Oh,
To minimize their U.S. tax burden,
right.
bringing it back would trigger a huge tax bill.
Wow.
So they borrow at low rates instead.
Okay.
It's actually cheaper than using their own cash.
Wow. That's some next level financial maneuvering.
Yeah, they're very smart.
It sounds like Apple has this whole capital structure game figured out.
They're definitely playing it strategically.
Yeah,
But let's not forget, every company's situation is unique.
right.
Take Tesla, for example.
Okay.
Their journey with debt and equity has been quite different.
Yeah, they've gone through explosive growth.
Oh, yeah.
I bet their financing needs have been wild.
Wild is an understatement.
Tell me more about their approach.
Early on, Tesla was a risky startup. Traditional lenders weren't exactly lining up to throw money at them.
Right.
So they relied heavily on equity financing,
Yeah.
selling off pieces of the company to fuel their growth.
Makes sense. High risk, high reward.
High risk, high reward, exactly.
But it must have come at a cost, right?
It did. They issued a lot of stock,
Oh,
diluting early investors.
okay.
But it was the only way to secure the funding they needed
Yeah,
to get off the ground.
right. As they matured,
Mhm.
their cash flow increased,
Right.
giving them more options.
Exactly.
So they started using more debt as they became more established,
Yeah.
like graduating from credit cards
Right.
to a proper mortgage.
Precisely. They strategically took advantage of low interest rates to secure loans,
Okay.
funding expansion,
Mm-hmm.
while minimizing further dilution.
That makes sense. It's fascinating how a company's capital structure
Yeah,
can evolve alongside its growth.
it really is.
All right, so we've got these real-world examples showing us how these choices play out.
Right.
But what about the bigger picture?
Okay.
What factors do companies consider when trying to strike that ideal balance
Right,
between debt and equity?
There's no one-size-fits-all answer,
Okay.
but let's look at some key things they weigh.
All right.
First, industry norms.
Okay.
Some sectors are naturally debt-heavy,
Mhm.
like airlines and utilities.
Why those specifically? What makes them different?
They require massive upfront investments.
okay.
Planes, power plants infrastructure.
Yeah.
Debt financing is often the only way
Oh, really?
to get those projects off the ground.
So the nature of the business itself
Yeah,
plays a role.
definitely.
What else?
Market conditions are huge EE.
Okay.
Low interest rates make debt more tempting.
Great.
High rates. Companies might lean on equity instead.
So it's about timing, too.
It's like timing the stock market,
Right.
but for borrowing money.
So it's a bit of a gamble, too.
It is
Interesting. Do companies factor in their own personality? Oh, totally.
when making these choices.
Absolutely. Risk tolerance varies wildly.
Right.
Some companies are inherently conservative,
Okay.
prioritizing a strong balance sheet,
Mm-hmm.
even if it means slower growth.
Exactly.
Others are more aggressive,
Yeah.
embracing leverage to fuel rapid expansion.
Oh, okay. So different approaches.
Very different.
It's like some folks are comfortable with a mortgage,
Uh-huh.
while others prefer to save up and buy their house outright.
Right.
Different strokes for different folks.
Exactly.
And of course, we can't forget about those lovely taxes, right?
Oh, never forget about taxes.
They always get their cut.
They always do. Tax implications are always on the table.
Okay.
Remember Apple's overseas cash dilemma?
Yes.
Those considerations can make a huge difference in choosing debt or equity.
Okay, so we've got this mix of industry norms,
Mm-hmm.
market conditions,
Right.
risk appetite,
Yes.
and those ever-present taxes.
Always there.
It's a lot to juggle.
It is. I bet there are some theories out there trying to make sense of it all.
Oh, there are plenty.
Okay, I'm all ears. Hit me with some of these theories
Okay.
that try to crack the capital structure cloud.
One famous one is the pecking order theory.
Pecking order. Okay.
It suggests companies have a preferred order.
Okay.
Internal funds first,
Mm-hmm.
then debt,
Right.
And lastly, equity is a last resort.
So it's like use your own piggy bank first,
Yeah.
then borrow from a friend,
Uh-huh.
and only sell your prized possessions if you're desperate.
That's the gist.
Okay.
It minimizes costs
Right.
and maintains control.
Makes sense.
Another influential one is the Modigliani-Miller theorem.
Modigliani-Miller.
Okay. Which proposes that in a perfect world,
A perfect world.
capital structure wouldn't even matter.
Now that's intriguing. Tell me more about this utopian vision.
The idea is that without taxes, bankruptcy costs,
Right.
or other market imperfections,
Okay.
a company's value is solely determined by its assets and earnings, regardless of how it's financed.
So the mix of debt and equity is irrelevant in this perfect world.
In theory, yes.
Sounds a bit too good to be true.
You got it.
Yeah.
We don't live in a perfect world.
Sadly, no.
Taxes, bankruptcy risks,
Yeah.
they all make capital structure a very real concern.
Right.
These theories provide food for thought,
Okay.
but ultimately, each company has to find its own path.
All right. So we've got these maps and compasses.
Yeah,
But the terrain is constantly changing.
it is.
All right. We've covered a lot of ground in this first part.
We have.
Debt versus equity, the factors at play, those fascinating examples of Apple and Tesla.
Definitely.
What are some of the key takeaways so far?
I think we've learned that capital structure is a dynamic balancing act
Right.
with no magic formula.
Okay.
Debt can be cheaper but riskier,
Mm-hmm.
while equity offers flexibility but dilutes ownership.
Yeah.
And real-world factors like industry norms, market conditions,
Right.
and even a company's risk appetite all play a part.
It's more than just a numbers game.
Yes.
It's about understanding how these choices impact a company's ability to grow,
For sure.
navigate risks, and ultimately achieve its goals.
Absolutely.
I'm ready to dive even deeper into how to actually analyze these choices,
Yeah,
like a financial detective.
that's exactly where we're headed in part 2.
Sounds good.
We'll equip you with the tools to decipher those financial statements.
Okay.
Understand key ratios,
Mhm.
and even spot potential red flags.
Sounds good. Until then, keep thinking about those companies you interact with every day.
Yeah.
Are they playing it safe with equity, leveraging up with debt,
Right.
or maybe finding some clever hybrid approach?
Mm-hmm.
The answers might surprise you.
We might.
All right, we've laid the groundwork,
Mm.
debt versus equity, those strategic choices companies make.
Right.
But how do we, the non-financial wizards, actually analyze a company's capital structure?
Yeah, good question.
Where do we even start?
It's like learning a new language. At first, those financial statements seem intimidating.
Yeah, they can be.
But once you know the key phrases,
Mm-hmm.
it opens up a whole world of insight.
Okay, so we're talking financial statements.
Yeah.
I know those can be dense,
Yeah,
but you're saying they hold valuable clues,
totally.
like a treasure map to a company's financial health.
Exactly. And the best part is,
Yeah.
they're publicly available for most companies.
Yeah, that's good.
2 key ones for capital structure analysis
Okay.
are the balance sheet and the income statement.
All right, the balance sheet.
Right.
That's the snapshot of what a company owns,
Uh-huh.
assets,
Yeah.
and how they're financed,
Right.
liabilities, and equity.
Precisely. Think of it as a scale.
Okay.
On one side, you have assets.
Yeah.
And on the other, you have liabilities and equity.
Right.
The proportions here tell a story.
Okay.
If a big chunk of those assets are financed by debt,
Yeah.
that company might be highly leveraged.
Leveraged meaning they're using a lot of borrowed money.
That's right.
And that's not always a bad thing, is it?
You're getting it. Context is key.
Okay.
For a company in a stable industry with predictable cash flow,
Mhm.
like a utility company,
Right.
a lot of debt might not raise too many eyebrows.
Okay.
But for a company in a volatile market
Yeah.
where things can change quickly,
Right.
high leverage could be a sign of trouble.
So like a tightrope walker, they need to be really good at balancing
Totally.
to avoid a nasty fall.
Yeah, for sure. What about the income statement?
Okay. The income statement.
What clues does that hold?
Yeah. What's in there?
The income statement is all about profitability over a period of time.
Okay.
We're looking at how much of their earnings are being gobbled up by those interest payments.
Ah. So if a big chunk of their profits is going straight to servicing debt,
Mm-hmm.
that leaves less for things like reinvesting in the business,
Right.
innovating, or even paying dividends to shareholders.
Exactly. It could be a sign
Okay.
that their capital structure is actually holding them back from reaching their full potential.
Okay, we've got these 2 key statements.
Yep.
But I'm guessing there are ways to cut through the noise
Oh, yeah.
and make sense of all those numbers, right?
Definitely.
Some secret decoder rings for financial statements.
That's where financial ratios come in.
Oh, okay. Financial ratios.
They're like shortcuts,
Hmm.
giving you quick insights into a company's leverage and financial health.
Right.
One of the most common is the debt-to-equity ratio.
Okay. Debt to equity.
Yeah.
That sounds fairly self-explanatory.
It is.
How much debt compared to their equity?
Exactly. What's a healthy range there?
There's no magic number,
Okay.
but a ratio above 2 might make you pause.
Oh, okay.
It suggests the company is relying heavily on borrowed money,
Yeah.
which could make them vulnerable.
Makes sense. Are there any other ratios
Well, there are many.
that are particularly useful for deciphering a company's capital structure?
Another good one is the times interest earned ratio.
Times interest earned.
It tells you how easily a company can cover its interest expense
Okay.
with its earnings.
So if a company is barely scraping by,
Yeah.
making just enough to cover their interest payments, that ratio would be pretty low, right?
Exactly. A low times interest earned ratio is a red flag.
Okay. Yeah, red flag.
It means they're walking a tightrope
Mm-hmm.
and could easily stumble if their earnings take a hit.
Right. All right, so we're armed with our financial statements,
We are.
these handy ratios.
Yep.
And we're starting to decode the story of a company's capital structure.
We're getting there.
But it's not just about the numbers, is it?
You're spot on.
There's more to the picture, right?
Numbers alone don't tell the whole story.
Okay.
We need to consider the qualitative factors too.
All right.
The company's industry, their growth potential,
Mm-hmm.
the overall economic climate.
Right. Like two companies could have similar debt-to-equity ratios,
Yeah.
but one might be a risky startup and the other a well-established giant.
Exactly.
Yeah.
Apples and oranges, basically. Basically, apples and oranges.
A high debt load might be acceptable for a fast-growing tech company,
Okay.
plowing money back into innovation.
Right.
But for a mature company in a slow-growing industry,
Yeah.
that same level of debt could be cause for concern.
It's like those personal finance gurus who say, don't compare your spending to your friends.
Right.
Everyone's situation is
I
different.
love that analogy.
And just like with personal finance,
Mm-hmm.
you need to look beyond the surface.
Definitely.
Read industry reports, understand the competitive landscape,
For sure.
and consider the management team's track record and strategic vision.
Absolutely. It's like being a detective,
Right.
piecing together clues from different sources to get the
Yeah.
full picture.
So we've talked about analyzing existing capital structures,
Yeah.
but what about those moments when companies decide to shake things up,
Right.
to change their financing mix?
Those are some of the most exciting moments.
Oh, really?
They often signal a strategic shift,
Okay.
a bold bet on the future, or a response to changing market conditions.
All right, let's break down these scenarios.
Okay.
When might a company decide to take on more debt?
A common reason is to fund a major investment,
Okay.
building a new factory, acquiring a competitor,
Mm-hmm.
expanding into a new market.
Makes sense.
Debt can be a powerful tool for growth,
Right.
especially when interest rates are low.
Like taking out a mortgage to buy a bigger house,
Yeah,
but on a corporate scale.
exactly. And just like with a mortgage,
Right.
companies need to be confident they can generate enough cash flow
Yeah.
to cover those debt payments.
Makes sense. What about issuing new equity?
Right.
When is that the right move?
Companies might turn to equity when they need a big cash infusion,
Okay.
but don't want to or can't take on more debt.
Right.
Maybe they're in a risky industry,
Mm-hmm.
or they're worried about becoming too leveraged,
Oh, okay.
or maybe they're riding a wave of hype.
Oh, yeah.
Their stock price is soaring,
Mhm.
and they see an opportunity to raise capital at a favorable valuation. You got it. Issuing equity when your stock is hot can be a savvy move.
Mm-hmm.
You raise a lot of money
Yeah.
without taking on debt or diluting existing shareholders too much.
So it's a bit of a balancing act,
It is,
weighing the cost of dilution against the benefits of raising capital.
for sure. Now, what about those share buybacks we mentioned earlier?
Oh, yeah. Share buybacks.
Why would a company buy back its own stock?
Yeah. Why would they do that?
Share buybacks or stock repurchases are fascinating.
Okay.
The company uses its own cash to buy back shares
Mm-hmm.
from the open market,
Right.
essentially reducing the number of shares outstanding.
So fewer slices of the pie,
Right,
which could make each existing slice more valuable.
precisely. It can boost earnings per share,
Okay.
a key metric investors watch.
Mm-hmm.
And it signals the company believes its stock is undervalued.
Interesting.
Like saying, we think our stock is a bargain, so we're buying.
That's a powerful statement.
It is.
It's like putting your money where your mouth is. It seems like share buybacks can be a way to reward shareholders, boost the stock price, and maybe even fend off a hostile takeover.
You've hit all the key points.
Wow.
It's a versatile tool.
Okay.
And understanding why a company is buying back its own stock
Yeah.
can provide valuable insights.
This whole conversation has really highlighted the complexity of capital structure.
It really has.
It's more than just crunching numbers.
It is.
It's about understanding the strategic implications of these choices
Right.
and how they can shape a company's destiny.
Absolutely. It's not a static concept.
Right.
Capital structure is constantly evolving
Okay.
as companies adapt to new markets, regulations, and even global events.
All right, before we jump into the future of capital structure, let's recap the key takeaways from this segment.
Sounds good.
We learned that analyzing a company's capital structure starts with those financial statements.
Yep.
The balance sheet and income statement,
Right.
they're packed with clues about a company's leverage and financial health. We also explored those handy financial ratios, like debt to equity and times interest earned, which help us cut through the noise and quickly assess a company's risk profile.
For sure.
But we emphasize that numbers don't tell the whole story.
Right. They do.
We need to consider qualitative factors too,
Absolutely.
like the company's industry growth prospects and even the management team's vision.
It's all part of the puzzle.
We also looked at those pivotal moments when companies changed their capital structure,
Yeah.
taking on more debt for expansion, issuing new equity for growth,
Right.
or even buying back their own stock to boost shareholder value.
For sure.
It's a dynamic process.
It is.
With companies constantly evaluating their options and adjusting their approach.
Absolutely. Now, as we look ahead,
Yes.
I'm curious about those emerging trends you mentioned earlier.
Okay.
What's on the horizon for capital structure?
Yeah. What's coming next?
What new forces are shaping these decisions?
Okay.
That's where things get really interesting.
All right. I like where this is going.
We're seeing the rise of alternative financing,
So,
the growing influence of ESG factors.
right.
It's a whole new landscape out there.
Sounds like we're in for a wild ride.
We are.
I'm ready to dive into these trends and see how they're changing the game.
Let's do it.
All right, we've gone from debt versus equity all the way to analyzing companies like financial detectives.
Yeah.
But now let's look ahead.
Okay.
What's changing in the world of capital structure?
Right.
And what does it mean for investors, businesses? Really, anyone who wants to understand how money makes the world go round?
It's a big question.
It is a big question.
One trend that's impossible to ignore is the rise of alternative financing.
Alternative financing.
We touched on this earlier.
Yeah.
Crowdfunding, venture debt. These aren't just niche players anymore.
Right.
They're becoming mainstream,
Okay.
especially for startups and smaller companies.
It used to be you had limited options,
Yeah.
bank loans, maybe some angel investors,
Nice.
and if you were lucky, venture capital.
If you were really lucky.
Now it's like a whole buffet of funding choices has opened up.
It really has.
What's driving this shift?
I think technology is a huge factor.
Okay.
Online platforms connect companies and investors, making fundraising faster, easier, and often cheaper.
Right.
It's democratizing access to capital in a way we haven't seen before.
And I imagine the tighter lending standards after the financial crisis played a role too.
For sure.
Banks got spooked,
Yeah, they did.
making it tougher for some companies to get traditional loans.
Definitely. That created a vacuum for alternative financing to step in and fill the gap.
Right. So it's a mix of tech innovation, changing regulations,
Right.
and evolving market dynamics.
It's a whole new world out there.
But how is this impacting capital structure decisions?
Yeah, that's the key question.
Is it changing the game or just adding some new pieces?
I think it's giving companies more options,
Okay.
more flexibility to tailor their financing to their specific needs. They're no longer stuck with just the debt or equity dilemma.
So they can mix and match, get creative with their funding cocktail.
Precisely. We might see companies using a blend of traditional bank loans,
Okay.
convertible debt, equity crowdfunding, and venture debt.
Wow.
It's about crafting a capital structure that fits their risk appetite,
Right.
growth goals, and stage of development.
It's like those build your own burrito places.
Yeah.
Everyone gets exactly what they want.
I like that analogy.
But this requires some serious financial expertise, right?
Absolutely. Companies need a savvy team
Yeah.
who understand these new financing models, not just the numbers,
Right.
but the legal and regulatory aspects, the impact on investors,
Yeah.
even corporate governance. It's complex stuff.
Okay, so alternative financing is shaking things up.
Definitely.
What other trends are on the horizon?
Okay.
What else might disrupt the world of capital structure?
One that I'm particularly interested in is the growing focus on sustainability
Okay, sustainability.
and ESG, environmental, social, and governance factors.
ESG is everywhere these days.
It really is.
But how is it impacting how companies raise and manage capital?
We're seeing new financial instruments emerge,
Okay.
like green bonds and sustainability-linked loans.
Green bonds, sustainability-linked loans.
With these, the interest rate a company pays is tied to their performance on ESG metrics.
So if a company hits their sustainability targets,
Uh-huh.
they get rewarded with a lower interest rate.
Exactly.
That's amazing. It aligns financial incentives with doing good for the world.
It does. It's attracting investors
Right.
who want both financial returns
Mm-hmm.
and positive impact.
Makes sense.
Companies that ignore ESG might find it harder to access capital,
Oh, interesting.
while those that embrace it could have a real edge.
So it's not just about being good anymore.
Yeah.
It's becoming a smart business move,
Absolutely.
impacting their cost of capital.
Exactly. That's a powerful shift.
It is. It's driving innovation in finance.
Mm-hmm.
We might see even more new tools emerge. Yeah.
That support sustainable investments
Right.
and reward responsible companies.
For sure. This is all so fascinating.
It is.
It feels like we're witnessing a fundamental change
Yeah,
in how we think about money and its role in society.
I agree. It has the potential to create a more sustainable, equitable, and prosperous future for everyone.
Well said.
This has been an incredible deep dive.
It has.
From the basics of debt and equity to the trends shaping the future of finance.
We've covered a lot of ground.
We have. Before we wrap up, let's recap the key takeaways from this final segment.
Feels good.
We explored the rise of alternative financing with crowdfunding and venture debt, giving companies new ways to access capital.
Right.
And we discussed how this is allowing companies to create more customized capital structures, moving beyond the traditional debt or equity choice.
Exactly.
We also delved into the growing importance of ESG factors, with green bonds and sustainability-linked loans becoming increasingly popular.
And it's clear that these trends aren't just fleeting fads.
No, they're not.
They're reshaping the financial landscape
Absolutely.
and pushing us towards a more sustainable and equitable future.
I couldn't agree more.
So as we conclude this deep dive, I want to leave you with this thought.
Okay.
As technology continues to advance at an incredible pace, what new and innovative capital structure models might emerge?
Yeah, what's next?
How will AI, blockchain, and other emerging technologies disrupt the world of finance and create new opportunities?
Those are excellent questions.
They're big questions.
The answers will shape the future of capital structure and the global economy for generations to come.
Thanks for joining us on this exploration of capital structure.
It's been a pleasure.
We hope you've gained valuable insights to help you navigate the ever-changing world of finance.
Yeah, definitely.
Until next time, keep exploring, keep learning, and keep asking those insightful questions.
That's the key.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.